Hi, and welcome to the Macro Show. We talk macro, and you wonder why some banks are withholding the stimulus checks until the 17th. We've got that. We've got G-SIB scores. We're going to talk about the SLR Rule again. I've got a little more information on that. After all, the Fed is meeting this week. There's an FOMC meeting tomorrow and Wednesday with a press conference on Wednesday by Fed Chair Powell. Are we expecting something? Well, maybe it's a conspiracy theory, but the data kind of suggests there could be something. We'll talk about that. We've got hedge fund positioning, foreign held Treasury security positioning, all kinds of good stuff. Now, I did create a supplemental. Many of you did enjoy the last update. I will post a link to this. It's already out on Facebook, LinkedIn, and Twitter. So if you're already following me on one of those places, you will have seen it. I will post a link to this in the description below. And I know I am not planning on including this with every update, but just so you know, we've got that for this one. So let's talk about what's going on. On Saturday evening, all of a sudden there was some news that broke that some banks, now like Wells Fargo and I think JP Morgan and some smaller banks, were not depositing the stimulus checks into people's accounts. It was showing as pending. Now other people said, no, I'm getting mine. My bank is processing it. And all of a sudden, some people were getting upset. And there was a big discussion on Twitter. A number of us were talking about like, hey, what's really going on? Because the question is, why did the Biden administration say that checks were going out this weekend? And why did some congressmen and women say checks were going out this weekend if they really weren't going out for some people? Why do some people get them and some other banks say, no, we're not ready for that yet? We're waiting till the 17th. Well, it turned out that the IRS said, well, there's some, rules about, this is not going to happen till the 17th. But then it comes back to, if that was the case, didn't the Biden administration know this? Didn't the congressmen and women know this? And then why are some banks front running this? It doesn't make any sense. So what is special about the 17th? Well, perhaps the question then is, why isn't this being fixed today? Or even tomorrow? How hard would it be for somebody, in the Biden administration to call the IRS and say, hey, you know what? We need to move that date up and get those checks deposited. So what is happening on the 17th? The FOMC, the Federal Open Market Committee, is meeting and Powell has a press conference. So could it be that there is some influence going on behind the scenes where the things we talked about last week where the banks cannot accept this money? Notably, we'll talk about Wells Fargo and JP Morgan situation. And they're looking to the Fed, and the Fed is preparing to make an announcement to smooth things over. Well, that could be the case. So let's talk about this thing called G-SIB scores and how that relates to all this. Now, a G-SIB score is a global systematically important bank. So you heard the phrase too big to fail? That's a G-SIB bank. So if your bank's a G-SIB bank, and I'll show you what that looks like. So what was the purpose of the G-SIB score? Well, it was part of the Basel III regulations and was designed to score banks to determine who's too big. And if your score gets too big, well, then you get penalized and you have to take on additional capital surcharges, and that just makes you less competitive to other banks. And gives you the incentive to reduce your G-SIB score when it gets too big. Now, one of the problems with the G-SIB is part of your score weighting has to do with an increase in assets and deposits. Well, what is an increase in assets? Well, that would be from quantitative easing. And what is an increase in deposits? Well, that would be stimulus checks. So all of a sudden you can start to understand that if you're a large bank and you are facing a G-SIB penalty already, that maybe you really don't want these extra deposits, because the negative impact to consumers is it starts to reduce availability of credit. And what that means is banks then, as their score gets higher, they say, we don't want to lend. And right now, that's going to be an issue, especially when the economy is recovering. You want banks to lend. Now, the good thing about the G-SIB is it doesn't get adjusted until the fourth quarter. So the Fed in the fourth quarter, the Fed does all these things about, determine the scoring, and then they announce it for the coming year. So there's time right now for the Fed to do something. But let's take a look at what the G-SIB scores are. So here you can see I'm on financialresearch.gov, and the G-SIB capital surcharge is by color. And you can see JP Morgan Chase has the highest surcharge at 3.5%. Citigroup, Morgan Stanley. Here's Wells down here at 2%. And I don't know if Bank of America is depositing checks, but they're got a surcharge at 2.5%. So you can see why some of these banks do not want to increase their G-SIB score. And so what can be done about this? Well, there's a great article on Financial Services Forum called Surging Deposits and G-SIB Surcharges, Capital Regulation Risk Undermining the Economic Recovery. And let's go right to the end because it just has a great summary of this. And it says, foreign members have been leading the way in the banking sector's response to the pandemic by extending significant amounts of credit into the economy and providing households and businesses with safe, reliable, and remotely accessible deposits. So they're saying, hey, the banks are doing their part here. The large increase in deposits at foreign members, now foreign members is referring to the banks, risks reducing the availability of credit because of the mechanical relationship. Now, when you hear the term mechanical relationship, think of automatic. It's going to happen. You hit the certain level, this is going to happen. Between deposits and G-SIB capital surcharges. If increased deposits are allowed to result in an automatic increase in G-SIB surcharges, the cost of funding loans and providing credit to the economy will increase, which means they don't want to do it. The mechanical link between deposits and G-SIB surcharges also may limit the effectiveness of the Federal Reserve asset purchase policy because the resulting increase in cash deposits will put upward pressure on capital requirements and make it harder for foreign members to extend credit to the economy. Now, what could the Fed do here? Well, they could come out and just say, hey, there won't be any automatic increases to your G-SIB score due to deposits from the stimulus plan. Or they could say, hey, we are aware of this. We see it as a problem. And by the fourth quarter, we're going to have a solution. And because they've got to do something. The Fed has to calm the banks here and say, look, please take on these deposits. Please do it willingly. Continue to extend credit. And we are fully aware of your problem. And now the Fed doesn't actually have to solve the problem today. They can solve it in the fourth quarter. That gives them plenty of time to do that. Now let's go back to the SLR, because I've got a little more information on that. And this is an article from Global Capital. What is the SLR and how is it calculated? But really there's a part in here that I want to see if we can find. Here it is. Oliver Ireland, partner at Morrison & Foerster, notes that if the SLR is binding on a bank, it discourages firms from holding high quality and low yielding assets. What does that sound like? Yeah. Treasury bills, short-term treasury notes, because they are taxed by the leverage capital charge, just as high-risk, high-yield assets are taxed. So the quote, so the SLR is potentially going to create incentives for banks to adjust their balance sheets in order to deal with it. Says Ireland, a bank can reduce its SLR or increase its yield on assets which are subject to the SLR. It makes figuring out where to put your money significantly more complicated each time you add an additional capital calculation that works in a different way, like the supplementary leverage ratio. What that sort of means is it incentivizes the bank to take on riskier assets, which you would think by regulation is not what you would really want to happen here. Now, this is from Dave Rosenberg today. He describes the SLR as said the banks are required to reserve capital against these holdings, meaning the Treasury securities. And what the exemption is, it says you don't have to reserve capital against it. So is there a strong chance the Fed is going to extend the SLR exemption? Yes. And as our friend Brent Johnson pointed out on Twitter on Friday, he says, hey, look, even if they don't extend the SLR, they're going to do something because they need the banks to absorb all these Treasury securities. So maybe there's something else they're coming out with. Now, speaking of our friend Brent Johnson from Santiago Capital, those of you may know him as the dollar milkshake man, or if we might want to start calling him Master Shake. Anyways, he and I had a call on Friday and we were discussing what was going on with the primary dealer holdings. And that's this chart here. Why are the primary dealers suddenly selling some shorter term Treasury securities when they've been accumulating a ton of them and sitting on them? Obviously, they must feel confident about being able to resell these, because if you're a reseller and you don't want your inventory, well, there's a simple way to deal with it. You just sell it at any price and clear it out. The reason you're holding your inventory is because you have the perception that you're going to sell it at the price you want or even a higher price. So what could be the driver for that big drop in dealer positioning on Treasury securities? Well, it may have had to do with the passage of the stimulus bill. And with that, all of a sudden, the Treasury, the U.S. Treasury, says, hey, we need the cash. Now, you say, well, wait a minute, don't they have cash? Now, again, let's go back and discuss what happens when, at an auction, when a primary dealer bank wins an auction. The U.S. Treasury gives them the bill, note, or bond, whatever it is the dealer won, and the dealer gives them a reserve asset or one of those quantitative easing created assets. And so you have a liability. The bank now has a liability of the U.S. government, and the U.S. Treasury has a liability of the Fed. So from a balance sheet perspective, there's no change. Now the dealer's job is to go out and sell that, get the cash, and give it back to the Treasury, who then returns the reserve asset back to the bank. That's the game. But when the Treasury has a lot of money, the banks can sit on these securities and sell them over a longer period of time because there's enough other cash. But when you have 1.6 billion or trillion in the account, and the government just passed a 1.9 trillion stimulus package, not on top of the existing deficit that needs to be funded, you can get what's called a cash call. And that would simply be the U.S. Treasury contacting the primary dealer banks and saying, oh, by the way, we're going to need some money, and you're going to need to get us that money because you've got our Treasury securities, and that could force the dealers into selling them at any price. And what did the dealers do, though? They sold the short end, the ones that have the minimal fluctuations. They didn't sell a lot of the long end of the curve because those are the ones that have the potential to appreciate the most should interest rates go down. So you can see the dealers, are still bullish on the bond market. Let's take a look at hedge fund positioning in the futures market. So we'll go to hedgeopia.com and look at the peek into the futures through the futures. Of course, we've got charts from Brent and Stefan. We'll take a look at those as well. And so we see that speculators backed off on their 10-year Treasury shorts a bit. They backed off also on their 30-year, the long bond shorts, which are still heavily short. If you think this move off of the short position is substantial, it's nice, but it's still a hefty short position. Let's take a look at what we got from Brent, and he says, look, they backed off by 11,500 contracts on their net positioning. So speculators are still very, very short, but not as much. Here is the speculative positioning chart. And so they're, again, as we saw from Hedgeopia, not quite as short. And then from our friend Stefan with Skyway Asset Management, he sends us this chart, and he sends quite a few, and this one's probably the easiest one to look at. And you'll see the green part is long and the red part is short, but one thing he does is he likes to look at the total long and short. So he looks at dealer, commercials, and speculators and other reportables and lumps them all together and say, what is the total long position? What is the total short position? And so right now he's seeing longs built up, and in his emails to me, he says that is an indication to him that by later this year, we're going to see new all-time low in Treasury yields. Up top, he's got TLT charted there. So just to give you a little perspective of how he looks at the charts as I wanted to share them with you. So let's go on to West Texas Intermediate. No real change in speculative positioning here, despite oil prices looking like they're running into some resistance. How about the S&P 500? We see speculators backed off their longs a little bit, not much. And into the euro. Now, this is interesting because we're seeing the euro drop a bit. Now, what does that mean in terms of other asset classes? Well, in the trade-weighted dollar, the symbol DXY, the euro is the biggest position. So if you're seeing speculators back off their euro longs, you have to assume that's bullish for the dollar. What else would it be bearish for if the euro's going down? Yeah, it would be bearish for gold. So let's see what we've got with that. Gold futures, this is interesting because now gold futures are back down to where they were. The long positions are back maybe around where 1400, and yet people are still really bullish on gold. And as many of you know, I think it could go down substantially, but speculators are massively backing off their longs. Let's go on with the NASDAQ. Still net short, but not quite as net short. No major movements on the major equity indexes. We see the Russell going from short to long last week as everybody's crowded in on the U.S. reflation trade. This is probably the biggest bet on inflation in the history of the U.S. markets. And then we've got the dollar. So they're seeing slight Reduction in dollar shorts here, not huge, but slight reduction. Again, you paired with the euro, backing off those long positions. This is dollar. You start seeing some dollar bullish trends, some gold bearish trends. If the dollar gets going, it's the one thing that nobody's really factoring here at all. Let's take a look at the tick data. This is major foreign holders of Treasury securities. Now, this is interesting because back in January, people were saying nobody wants to buy bonds. Nobody, but yet, Japan bought and China bought and, well, some other countries bought too. To the fact that, well, they were buying bonds and they were buying bills. They were buying notes. They were buying bonds. They were buying lots of stuff. So let's look at a chart of, say, TLT. So right in here, when everyone's saying short, short, short because no one wants to buy, well, foreign investors were buying. So that, I would imagine that will have some influence on the overnight market. I don't know for sure, but I would imagine so. And then we've got from Northman Trader, for those of you who follow him on Twitter, he's got a chart here today on TLT. He said it's the most oversold ever. Now, what does most oversold ever mean? Well, when a stock gets in oversold position, it means that its price is below where it should be. So there's been so much selling against it that the price that it's currently trading at is lower than what it ought to be. It does not indicate that this is a bottom. It does not indicate that the price will go up tomorrow or next week. It's just saying that the current price is below where it should be, and that would be obviously bullish for bonds. Let's take a look real quick. TLT looks like it got some movement up. How to do an after hours trading after it saw that tick data, and didn't really do anything. So it looks like it spiked up and sold back down. We'll see where that goes at the end of the day. And how about the dollar? I think it found some movement up today. Again, when the dollar takes off here and its position is just looking beautiful for it to get going. And we talked about this before, bottoms in the dollar run around 3 months. Well, here we are around that 3-month mark. So the dollar gets going, bullish for bonds. And, we love that, of course, because we are in the bond kingdom. And be sure, thank you, my friends. Be sure to like, be sure to subscribe, and be looking forward to that Fed meeting coming on Wednesday. Of course, we'll be talking about that on the Wednesday Macro Show. Thanks for being fans. Thanks for watching, and we will see you on Wednesday. Bye now. The content of this video is provided educational information only, is not intended to provide investment or other advice. So it's not to be construed as recognition or solicitation by selling security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steve Van Meter, personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advising or Steve Van Meter Financial.